Hi, welcome to the Napthans podcast. I'm Keith Melling, head of the corporate department at Napthans, and I'm joined today by Farida Isaji, who's head of our wills, trust and probate team. We're here today to talk about inheritance tax and some of the recent changes that have been fairly well covered in the news and by people like Jeremy Clarkson, for instance. We're all conscious that there are changes happening with regard to inheritance tax, and that's particularly relevant for business owners. And so today, we'd just like to talk a little bit about what's changing, what the current position is, and what business owners might want to do to mitigate some of the risk arising out of the changes. So to begin with, Farida, are you able to take us through a little bit of a summary of what the current position is with regard to inheritance tax?
Sure. So, historically, pre-budget that was set in October 24, Rachel Reeves announced obviously what the new changes are. But previous to that, trading businesses, which qualified for what is called as business property relief and inheritance tax relief, allowed for businesses, so shareholders in those businesses, to gift to individuals or gift by will or gift in their lifetime completely free of inheritance tax. So most people would take the view that they're generally going to leave their shareholding on death for family succession. And what they would do is they'd get a capital gains tax uplift and they'd completely benefit from business property relief in a trading business. That allowed obviously the continuity of businesses. So that's what the position has been for a number of years, and most people have been reliant on that. But obviously, since the budget, that's completely changed.
Okay, so just to stop there, if I held shares in a trading company and that company was worth £10 million, for example, when I died, those shares would transfer to my next of kin if that's what my will provided for, and there'd be no inheritance tax charge on
Sure,
that.
as long as it was a trading business
Yeah.
and the business completely qualified for business property relief,
Right.
yes, that £10 million would transfer
Yeah.
as a shareholding to those individuals.
Okay. So what's changed that's got Mr. Clarkson out on the streets?
Well, it's not just got Mr. Clarkson, has it? It's got a number of people. So Mr. Clarkson, obviously, what we've got to just verify here as well, it's two types of reliefs that have changed. One is agricultural property relief and business property relief, but our
Okay.
focus today is obviously
Sure.
business property relief. So really, the changes are quite significant. What's happened now is the policy and the draft legislation says that an individual will be entitled to 100% relief on £1 million worth of shareholdings.
Right.
Anything above that will have an effective rate of 20%. So essentially, everything else qualifies for 50% of relief. And then thereafter, you'd be liable to a 40% tax. So when you work that out, it's an effective rate of 20%.
Right.
That's obviously caused a significant issue in terms of how business owners plan and strategically plan going forward. So in terms of if you had a £3 million business, let's just use simplistic numbers for calculation purposes, you would basically be paying on death an inheritance tax charge of £400,000. And yes, the government has allowed for a payment plan for that. So it's over 10 years and it's a interest-free payment plan. But that business will have to find that cash, or the estate will have to find that cash to pay that inheritance tax charge.
Right. So in my earlier example, if I've got £10 million of business assets, I'll get £1 million relief on the first million, obviously. 9 million will be subject to 20% tax, and I won't have actually sold those shares or received any cash. My family won't have done. They'll have to get the cash from somewhere, or as you say, pay over a 10-year plan.
Yes. And then obviously we're going to talk about sort of things that you can do to kind of try and mitigate that.
Right.
And I think one of the first things, I mean, a lot of people initially are talking about a simplistic way is to purchase insurance.
Okay.
So, and that's, speaking to your wealth managers to see if that's even possible.
Yeah.
There's obviously a cost associated with it, but that's probably the most straightforward way of somebody saying, well, we're going to have to buy insurance to pay this inheritance tax. The only concern around that is obviously if the business grows in value, so do the premiums for your life insurance. And
Right.
obviously it's always a matter of based on the individual and their age and all their health, etc.
Right, I see. Okay.
So that's probably a simplistic option in terms of, well, one of the options. In terms of going forward, I think what we have to discuss is what we can do now whilst we've got a window of opportunity to basically plan. So the changes are going to become effective in April 26, where actually at the moment there's an option of placing assets into trust, and you don't have an allowance there. You can actually transfer as much as you want at this moment in time, which isn't capped, so that all of that amount will get a relief. So there's not that £1 million relief, because post 26, what will happen is that if you then move in assets that qualify for business property relief, there'll be an immediate tax to inheritance tax at the point of those assets being worth more than £1 million. So what we're trying to do is we're trying to ring fence that and utilise that. We can talk about the benefits of having a trust, but ultimately I think the other option as well is to gift outright to individuals now, to bring in family members, so that we can say that we can spread the £1 million across individuals.
Right. Okay.
I think one of the things that we have to also mention at this point is that you don't actually have the £1 million transferable to your spouse.
Right.
So you're best utilising your £1 million, and then perhaps include, if you're the only shareholder, if you have a spouse, including them, because they'll also get a £1 million allowance.
Right.
Because they're not transferable like the other allowances are. So in your personal estate, you have things like the nil rate band, which is set at £325,000 each. And you also have the residence nil rate band. Those are actually transferable between spouses, but the policy direction is that these are not going to be transferable.
I see. Right. Okay.
There might be room for change, and we'll wait to see if that happens.
Yeah.
But what we have to do is actually ensure that we do make the most of your individual £1 million allowances.
Right.
So using a trust obviously allows you to then have control. So you could, the business owners could still be the trustees of that, but what they've done is moved assets outside of their estate, and subject to them surviving 7 years, those assets are ring fenced within the trust. Now, obviously, there'll be, administrative charges, tax charges within the trust, but they're nowhere as significant as the 40% or the effective rate of 20% going forward. The other thing is that also one of the things that that they can do is looking at gifting outright now to children. And I think one of the questions here is for you, Keith, is a lot of, if we've got owner-managed businesses, they might not want to actually gift right now to children because they're worried about how they will effectively manage that. What would you suggest in terms of protecting against those risks?
Yeah, it's a really good question. So most business owners are in the position they're in because they've run successful businesses, and they're very nervous about transferring control as well as value elsewhere. Now, if the answer is that you need to find other family members, create certain trusts who can benefit from that extra £1 million per head rule, you've got to be comfortable the people you're transferring the shares to, well, some power will transfer with those shares. So typically shares carry rights to receive dividends, rights to receive a capital return, including on an exit or a wind-up. But they also typically carry voting rights. Now, if I'm a sole shareholder of a company and I own 100% of the shares in that company, and I decide that I want to transfer shares to my wife and my 2 children, let's say, and each of us have the benefit of £1 million relief on each of our deaths, well, I've got to bear in mind that if I've given 75% away, 25% each to my wife and my 2 children, I'm suddenly a minority shareholder in that company. That means that I don't have the power anymore to make necessarily day-to-day decisions, or certainly to wield ultimate shareholder control. Now, the important point here is that it's ultimately the shareholders who can decide who are the board of directors of a company and who can run the company day to day. So whilst I may transfer my shares to my family and nothing may change in practice, I'm still on the board, in theory, my wife and my 2 children could decide they don't want to be on the board of the company anymore and take me off the board, and legally that's perfectly possible. So we've got to be careful here that there are protections put in place to make sure that, as the original founder, I retain some sort of control because I feel that I'm the person who can make the right decisions as to how the business goes forward, particularly if my spouse, my children aren't involved in the business. They're not close to understanding how it runs day to day. So to do that, you can do a number of things. One, you could put in place a shareholder agreement between the various family members. And that shareholder agreement might say that certain decisions would always need my approval before they could be taken. Or it may say that I would get the final say on any of these decisions and be able to drive through a decision if I choose to do it. The alternative is you may have heard of a concept of a family investment company. And family investment companies, or FICs for short, are often structured in a way which splits the control of the shareholding from the value of the shareholding. So what you may do is say, well, I've got 100% of the shares. What I will do, I will gift 75% of the shares to my family, but I'm going to keep my shares as the shares which carry all the voting rights. So the shares I give away won't have voting rights. That means I retain voting control because I can make all the decisions at shareholder level in the same way I always did before. And whilst my family members may have rights to receive income, rights to capital on an ultimate sale, they will not be involved in making decisions that attach to the shares or the rights that attach to the shares in terms of deciding who goes on the board and certain other key decisions that exist at shareholder level. So those are the two main things I'd suggest. Look at a shareholder agreement or look at structuring your company as a family investment company.
Okay. And that's the thing, isn't it, Keith? I think we need to look at this in the round as
Yeah.
well. I think one of the things that I haven't mentioned yet is actually post 27 pension pots are going to be coming into estates as well. So the tax liability from individuals will be quite significant. We're looking at a client now. We're working with accountants and wealth managers together, and we've told them what's the situation now if they don't do anything, and the current position in terms of what their tax liability would have been had the law not changed, what the tax liability will be if they do some pre-planning pre-April 26, if they do some pre-planning pre-April 27 in relation to pensions, and then if they didn't do anything, actually, what would happen? And there's actually, when we did those calculations, their liability at this point is £1 million because you're combining sort of the personal estate and the business estate. In a couple of years, it would be £2 million. However, if they didn't do anything, we were looking at a tax liability of £8 million.
Wow.
Yeah, so it's very significant, and that's why we're sort of recommending that actually we need to do something now.
Yeah.
And there's various options, and every individual circumstance, every business is different, every family is different. We will look at those specific circumstances, see what is best for them.
Yeah.
And we will work together with their professional advisors to ensure, that they've got the current structure in place now, but we'll also look at sort of their wider estate planning and obviously their wills to make sure everything ties in and that they're making use of their allowances.
Yeah.
So I think, and we have to work with our corporate advisors where the businesses are, because there may be a need to, and this is not for me to go into too much detail here, Keith, because this is your remit, obviously, but, looking at reclassifying shares and all those sort of things that we might need to do if we are going to gift into trust now to ensure, that there's control over what dividends, extras are paid on those shares. But all this is about having a roundtable discussion and taking the steps now.
And doing it as soon as possible, because you and I both know that lawyers can move quickly, but in order to get the right advice from all the relevant parties, which includes wealth managers, accountants and tax advisors and lawyers, we've got to be having the conversation now ready for April next year, because otherwise I personally think there's going to be an awful lot of clients wanting to change things and deal with this issue a bit late in the day.
Yeah.
And the sooner people come to this position now and start addressing the issues now and get the advisors together now, the quicker you've got that plan, you're not making a last minute decision that might not work for you in the long run.
Exactly. And I think, the tax advisors in some situations, depending on the value of your business and what assets are involved, you might even need HMRC clearance. And they've obviously got their own timescale. So albeit we can move quite quickly, it all has to dovetail in terms of the tax advice, like you said, the wealth management, and also us preparing the legal documents.
And getting valuations of shares and if that's
Sure.
relevant and so
Yeah.
on. No, you're absolutely right. So I think in summary, the key messages from this are, first of all, to appreciate the impact of what's happening. Secondly, understand what you can do to mitigate the risk, but more importantly, speak to your advisors as soon as possible and get everyone talking to each other.
Definitely, and understand what your own individual tax liability will be.
Yeah.
Yeah.
Farida, that's been great.
That's
Many
great.
thanks.
Thank you very much, Keith.
Cheers.